Hello everyone and welcome out to your Maverick Trading Market Foundations class on trading interest rates. And specifically we're going to talk about the bond market, trading vehicles that can take advantage of bond price movement, bond yield movement. Obviously this is a big driver of volatility here recently as we've seen yields spike up. That has created some kind of side effects in terms of people selling equities, and we'll talk about that intermarket relationship and just kind of make sense of these things together. As always, just a quick reminder that we're going to go through some live analysis, so make sure it fits your trading plan. So when you invest in the capital markets, there are really two main types of investments that you can make. There is debt and there is equity. So what's the difference between debt and equity? Well, equity is stocks, and they'll often call them equities or company shares. This is actual ownership of the company. Investors receive a return based on share price appreciation and or dividends. So when you buy equity, you're an actual owner. Debt works a little different when we talk about fixed income, and that's kind of the focus here when we're talking about interest rates. As the name suggests, fixed income is predetermined by the amount that an issuer is going to pay the investor. So when you invest in fixed income, you're not acquiring ownership in the company. Instead, you're basically giving and lending out money. You're giving this business, it could be a government, governments sell fixed income, but basically you are giving them money, and with that, they have a predetermined amount that they're going to pay you, a certain interest rate that is attached to that. It could be 5% annually, 3% annually, 12% annually, depending on what that is agreed to, basically. And of course, there's supply and demand at work. The person that is borrowing the money wants to pay as low an interest rate as possible. The person that's lending the money out wants to collect as much interest as possible. And so how does supply and demand work? Well, basically, the more risky you are, the bigger the interest you have to pay. The less risky, the lower the interest rate that you have to pay as a general rule. So when it comes to bankruptcy, if companies were to go bankrupt, the debt markets are usually higher on the claim scale than our equity. So if you are thinking back to companies going under, let's say General Motors, which went bankrupt. Yeah, when the equity was basically wiped out, it doesn't guarantee that the fixed income or the debt was wiped out. It could be that the company restructures and some of that debt stays. It could be that they were paid out a portion. They collected 20 cents on the dollar or something like that. Basically, there are certain claims to the assets. And so when you look at who's highest up on the claim, the debt holders get a claim before equity, which is, if you own the stock, you're kind of wiped out as a general rule. Debt might get something out of it. Well, if the company goes bankrupt, they might not get anything either, but they are higher on that scale. When we think about fixed income, it's a type of investment where there's a real rate of return paid out periodically at regular intervals. So there are some norms. It's not uncommon to have 2 payments per year. It's not uncommon for a payment to come out quarterly. It's not even uncommon for it to be an annual payment and so forth. The more regular the payment is, the more, of course, kind of people like that because they can plan for that. If you're retirement age, it's kind of nice to have it paid out monthly or quarterly or something like that, as opposed to just getting some big lump sum on an annualized basis. Fixed income can be a diversification tool as they tend to have less risk and less volatility than equities. So retired individuals tend to be a little bit more invested in fixed income. There's all different philosophies. I'm not going to give you any advice whatsoever on how much you should invest in stocks versus bonds and so forth in retirement accounts or anything like that. There's different thought processes. Some say you should be a lot more in equities and a lot less in bonds even when you get older. Some go by the rule of your age. So they say when you're 30, you should have 30% in bonds and 70% in stocks. When you're 70, you should have 70% in bonds and 30 in stocks. See how it flips? Your age kind of determines how much you have in bonds. So when you're young, you have less percentage in bonds. When you're old, you have more. There's the Warren Buffett philosophy. He came out and famously said you should have 90% in equities and 10% in bonds, which most would say that's quite extreme. But you know what? We've been through a multi-decade bond bull market, and with interest rates so low, it's hard to convince me that it's a great idea. I mean, you might do fine, and fine is if you invest in something that's yielding 3% and you happen to have that paid to you, they don't default and whatnot, well, you'll make your 3%. That's not very exciting on an annualized basis. And yields are down in the dumps. So there's not a ton of upside in investing in the fixed income markets that way, just from a yield perspective. There might be ways to trade the fixed income markets and make more than that and so on, but it is what it is. So you kind of have to look at that, what makes sense and whether you want to be invested in bonds and your retirement accounts and how much and so forth in the fixed income markets. That's kind of a personal decision. The most common example of a security that yields fixed income is a bond. These are issued by federal governments, municipalities, corporations. Treasuries pay a fixed income to investors as well. There's a few different types. They have Treasury Bonds, they have T-notes, they have T-bills. And the difference in these, there's really no difference other than the duration. So a bond would be something like a 20-year bond. A note might be 3 years, and a T-bill might be 1 to 3 months in duration. They just have different names basically based on the duration. Of course, one would anticipate that the 20-year bond would pay you more on an interest account, interest payments regularly than a 1 to 3 month T-bill. That would be anticipated, but there's something called the yield curve. The yield curve is basically the difference between what a short-term asset is yielding and a long-term asset. Right now, we have a really, really flat yield curve, meaning that the difference between a 2-year and a 10-year and a 30-year and so forth, it's not that much different, where you're at 2% and 3% and 4% in yield. That's not very exciting. And it's a flat yield curve, meaning that the difference between short-term and long-term rates not very extreme. A steep yield curve would be more attractive for investing in long-term bonds, simply because now the 2-year might be yielding 2, and the 10-year might be yielding 4, and the 30-year might be yielding 7 or something. Now you have a steep yield curve, and financial companies really like a steep yield curve because financials, big banks, they're borrowing short-term money and lending out long-term money. So the difference between these can be a profit to them as a financial institution. That's their profit margin. So it's been hard for financials to have this flat yield curve because the difference between short-term and long-term rates is not very different at all. Corporate bonds can include investment grade, junk bonds. There are credit rating agencies that actually rate these bonds. You've heard of Moody's and S&P. They rate the bond quality. Now, one of the biggest disasters we've seen was back in 2008. And a lot of people blame the credit rating agencies for that disaster. And that's because the rating system, they kind of made some mistakes basically in the way that they rated assets. And if you rate something, let's say, AAA, A plus, what have you, if they come out and give it that rating, there's a couple of things that happen. First of all, this is considered to be little to no risk. Essentially, that should not default. That's what the credit rating agency is saying. Now, as the assets started to crumble, they started to downgrade that from AAA to A, B, so on and so forth. And as it's dropping, the credit rating agency is downgrading that. There's a certain amount of collateral that has to be held to hold these assets and so forth. There's a certain amount of collateral that has to be held for insurers. So you take a company like AIG. AIG is a financial insurer, and they were insuring, they had insurance out on many of these assets. Well, if you're an insurance company, you have to hold money in reserves to be able to pay out on claims, right? Well, if it's rated AAA, the amount of money that they had to hold in reserves was tiny, tiny. As it gets downgraded, they have to hold more money because the default is that much more likely. And it got to the extreme where they had billions and billions of dollars worth of potential losses that they weren't going to be able to insure. And if they couldn't insure those losses, then the other financial companies that had bought that insurance were going to crumble, and it was all a big mess. So the government stepped in and basically backstopped some of these insurance policies, made sure there was enough money to back them up, bailed out the financial companies and so forth. Well, how did we get into that mess? Because Moody's and S&P and some of these credit rating agencies had given AAA ratings to junk assets, basically. When you hear about the financial crisis and you really wind it back, it had a lot to do with housing. And in the housing market, we'd never seen that big of a downturn. But what they ended up doing, remember that there were interest-only loans and all these loans that were going out that were very aggressive, people buying their fourth and fifth and sixth home with interest only, and they were not very credit worthy. Well, what happened is Moody's and S&P and these companies, they basically said that if we package up all of these mortgages, yeah, they're not good mortgages, right? These are people that are potentially going to default. But if we package them all up together and put them in these bundles, what are the odds that they're all going to default? Well, historically, not very high. So they started to convince these credit rating agencies that if we bundle them all up, yeah, they're all junk by themselves. But if we bundle them all up together, somehow, some way, these geniuses thought that if we put all this junk together, now it becomes AAA rated. Now it becomes, or highly rated, because they're not all likely to default. Yeah, some of them will go under, most of them will survive, and it'll be fine. So they gave them a high credit rating, even though as you break apart the bundle and you look at each one, they were all high risk. Well, obviously, that created huge problems because what was rated highly was not of good quality. As the housing bubble started to burst, many of those went under. All of a sudden, catastrophe and billions of dollars of losses for financial institutions, et cetera, bailouts, and so on and so forth. It was all from these assets that were rated investment grade but were really junk. Now, when you think about corporate bonds versus junk bonds, corporate bonds pay a lower fixed income rate. Junk bonds pay a higher yield. Why? Because again, the default risk. So think about what a bond is. Let's say we invest $1,000 into a bond. What are we doing? Well, we're giving the company that money. So the company collects $1K, and we get annual payments for lending them that money. Well, if it's a high quality corporate bond, if it's investment grade and so forth, we expect they're going to be able to pay that out. It's probably not going to pay us much in the way of interest rates, right? It might pay us 4% annually. If this company is at risk of defaulting, meaning they're never going to give us the $1,000 back, we're going to require a much higher interest payment, maybe 10% or something like that. So it depends on what the quality is. Are we going to get the $1,000 back? If it's very, very highly likely that we are, that at the end of this, maybe this is a 10-year bond, at the end of 10 years, if they're going to give us back the $1,000 and they're going to pay us this interest payment annually, we're going to require less interest because, hey, they're going to pay us back the money. But if there's risk that they won't, we're going to force them to pay us a higher interest payment. And that's, basically the bond quality versus the rate that it's paying will have that relationship that way. So let's understand why treasuries and bonds are fixed income. Think about a 5% annual interest rate that's due to mature in 5 years. So this investor is going to collect 5% annually for 5 years, and then at the end of the 5 years, they should get paid back the amount of money that they had invested in that bond, right? So the company issues this bond to raise funds for capital projects, whatever it is. The company has a reason they wanted to borrow this money. Investors lend money to the company by purchasing the bond, and then they're told they'll collect 5% annually. The interest rate is known as the coupon rate. So a bondholder that purchased $10,000 worth of these bonds would receive 5% annually, or $500 every year. 5% of their $10,000 investment is $500. This is fixed and represents a steady income. That $500 could come out in annual payments. It could come out, twice a year, where they pay $250 and then $250 more, and so forth. That money comes out and is paid to all the bondholders for having borrowed that money, right? So why do bonds and yields move in opposite direction? Because there are new bonds constantly being issued. In that prior example, we bought a 5-year bond with a payment of 5% annually. Well, let's say a year later, the same company wants to borrow more money. And now interest rates have gone down. Now they're selling a 5-year bond, but they only have to pay 4%. Now ours only has 4 years left, right? So we're now down to 4 years, but it's paying 5%. So you tell me, which one's more attractive? Do people want the bond that's paying 5% more than they want the bond that's paying 4%? Well, of course, the answer is yes. A 5% yield is better than a 4% yield. So this bond value will have gone up. Instead of it trading for $1,000 per bond, it might be trading for $1,050 or whatever it is, $1,020. It will have increased. So instead of having, that would be times 10. We said we had invested 10,000. So let's say that this is now worth, I'll change the number a little. Let's say it's worth $10,200. Okay? It's worth more money. What does that mean? Well, you could trade out of this bond. You could sell it, and what would you have made? Well, you made the 5% because you held it for a year. So you got 5% on that money, plus you'd make $200 in capital appreciation. Notice that you can make money on the bond itself if it goes up in value and you sell it. You invested $10,000 and now you can sell it for $10,200. So not only did you make the $500 in interest, you made the $200 in capital appreciation, you made $700 over that year if you sell that bond. Well, you might decide, I just want to hang on to it because it's paying 5%. And if I had to go buy a bond right now, it would only pay me 4%, right? So you can buy and sell these bonds. Now, let's change it, okay? If you the comment came in, if you hold that 5% until it matures, will we still receive the 10,000 investment back? The answer is yes, assuming the company doesn't default. They could default, but assuming they don't default, in 4 years, you'll get $10,000 back. You won't get $10,200, right? You're just going to get that $10,000. Now let's change up the scenario. We bought the 5-year bond for 5%, but now new bonds are coming out with 5-year duration, and they're yielding 6%. Does that change things? Yes. My bond has 4 years left, but it's only paying me 5% annually. New bonds are being issued by the same company, same credit quality, and they're yielding 6%. Maybe even they sold one that's a 4-year, so it could be identical to ours, only now they have to pay higher rates. Some reason investors are requiring a higher interest payment, and that's what's happening today in the markets. When we're talking about rates going up, investors in bonds are requiring a higher interest rate. Rates have been going up. So what does that do to the bond price? To the question, why do bond prices and bond yields move in opposite directions? Because now the new bonds are yielding 6, but mine is only yielding 5. Mine is not as attractive. So if I wanted to sell out of it, it's worth $9,800 perhaps, right? I put $10,000 into this, but I can only sell out of the bond for $9,800. So yeah, over that year I made $500 in interest, but I lost, if I sell this, I lost $200 in the bond value. So I only made 3% for the year. I only made $300. Now notice over here, you made 7%, $700. Because yields went down, your bond went up in value and you could sell it for more. But if yields go up, your bond went down. Bond prices and yields are moving in opposite directions. So if yields went up, my bond value goes down. If I want to sell out of it early, I'm going to take a loss on the bond. I did make the $500 in interest, but see, it's a smaller return. Now, once again, do I have to sell this? No. I could hold it for 4 more years, and I'm going to get paid back $10,000 for it. So I don't have to sell it at a loss. I can keep collecting my 5%, but my 5% is not as good as these people collecting 6% annually, right? Instead of collecting $500 a year, these guys are collecting $600 a year on their 10,000 investment. So bond prices and yields are moving in opposite directions. So let me kind of simplify this. If you are trying to play bonds for capital appreciation and so forth, when would you want to buy bonds? When do we buy? Well, you'd want to buy a bond if rates are going down, right? That would cause your bond to go up in value. If rates are going down, if you foresee that rates are headed downward and so forth, then you'd want to buy bonds because you can lock in at higher interest rates. That's good because they're paying you more interest. And if the rates drop, your bond's going to look very attractive compared to new bonds, and you can sell out of them at a premium. What, right? So when would we sell bonds? When would you want to bet on bonds going down? Well, of course, it's the opposite. If rates are going up. And I don't have the best handwriting, but to write with a mouse has never been a skill of mine. So when do we sell? When rates are going up. If you felt like rates are headed upward, then bond prices are going down. It's kind of a double whammy for 2 reasons, right? Because if you were to buy bonds and rates go up, then everybody else is, these new bonds are collecting more than you. That's not good. But on the flip side, if you wanted to sell out of your bond early, now you got to sell it at a loss. You got to sell it at a discount because all these others are yielding more than your bond. So, bond prices and yields move in opposite directions, as you can see there. Will bond prices go down if credit ratings decrease, even in a steady interest environment? Yeah, I mean, there can be market effects. If there's a change to the perceived credit quality, you always have to think about, if I have $10,000 invested in this bond, if it becomes more risky, I'm assuming I'm getting this money back 5 years from now. But if they start, reducing the credit rating and so forth, just think about the financial crisis in 2008. A lot of those companies were highly unlikely to survive. And so their bonds sold for pennies on the dollar, because you'd rather sell it and get, 20 cents on the dollar than wait another month and get zero. And so they were trading at big discounts because of the expectations they were going under. Now, there could have been huge opportunity there, because if you'd have bought for 20 cents on the dollar and that company didn't go under and somehow survived and kept paying their interest payments and, yada, 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 well, you got a huge opportunity, because you bought a distressed level and it rebounded and it came back. So that's the market. But yes, in the market, there's not usually that much volatility in bonds. I'm kind of going back to about the most extreme examples we have. 2008 credit crisis was one of those extremes. So how can you analyze and trade bonds? Well, you can follow the yield, and here are some symbols. This is from stockcharts.com, and these will just show you basically the yield of 30-year or 10-year or 5-year or very short term. $ TNX is probably the most popular. The 10-year is often quoted. What is a 10-year bond going for, and so forth? And right now, just to kind of put things into perspective, let's talk about 10 years. I don't know the exact numbers, but I know ballpark figures, okay? So I'm going to give you some examples. In the U.S., what is a 10-year bond yielding right now? It's about 3.2%. So if you lend the U.S. government $1,000, they're going to pay you 3.2% on that 1,000 annually, right? They're going to pay you interest of about 3.2%. Well, in Canada, Canada is yielding 2.5-ish. Okay, so not too different. Kind of interesting that the largest economy in the world has to pay a higher interest rate than Canada, right? So the perceived credit quality apparently is that Canada is more likely to pay their bills than the U.S. Kind of weird, maybe. Brazil. Let's go to an emerging market and use an example. Brazil's in the 10% neighborhood. Now, again, I don't know the exact numbers, but it's in that ballpark. Let's go to a big, developed, one of the strongest economies in the world, Germany. Now, Germany's part of the European Union, but they have all their own debt. So this was a big problem. You remember the Greek credit crisis. Greece is a part of the Eurozone, but Greece had its own debt. All these countries do. And Greece looked like they were going to default, and they had all these problems. Well, Germany, guess what it pays? 0.5%. So people are willing to give Germany money and collect 0.5% on it for 10 years right now. Look at the difference. Look at the discrepancy. Apparently, people are very, very confident that Germany is going to be able to pay their bills. Little less confident about the U.S. or whatnot, but Brazil and some of these emerging markets, and there would be other examples. I mean, it's sometimes crazy. These are these are government bonds around the world. Well, Argentina, a recent story, Argentina came out with a 100-year bond. And it came out and it was yielding something like 8% annually. So they said, give us money, we'll borrow it for 100 years, and we'll pay you 8% on it. I don't remember, don't quote me on the 8%. That might not be the exact, but it was in that ballpark. Okay. Argentina had defaulted on their bonds something like, 4 times in the last 15 years or some high number, right? They don't have a great track record. Well, they just defaulted again. So they came out with these 100-year bonds, and guess what? It was oversubscribed, meaning more people wanted to invest in that than, it basically, they yielded less than what they had expected because so many people subscribed to it. And then within a couple of years, they defaulted again. All of those wiped out. How good is it to make your 8% for 2 years and then have all your money wiped out? Well, it's not a good trade-off. Losing 100% and making 16% off of it is net a loss of 84% of the capital, and it's a bad situation. So just because a government is making promises does not mean that they won't default on their debt. Now in the US it's never happened before, but of course it can. So let's look at a couple of these charts. Here's TNX. Now this is just showing the yield. So remember, when you pull up these yield charts, they're going to show what the yield is doing, and it's going higher. Now you can put this kind of into perspective in terms of rates. So if it's at around 28, that's about 2.8%. When it's up here at 32, it's about 3.2%. That's one way to kind of think of it. But you can see the relative change. You can see how over the past couple of months, rates have been going up a lot, right? The relative change. Now put things into perspective further. In 2016, just 2 years ago, what was this 10-year going for? Would you believe me if I said that 10-year rates in 2016 were at 1.4%? Just 2 years ago, they were at 1.4. Now they're at 3.2. And the question is that what the market is concerned about is how high are they going over what period of time? If rates are going up for the right reasons, like, the economy's chugging along and it can handle it, and, it's more normalization, because paying 1.4% is not normal. But 3.2, is it going to 4? Is it going to 4.5? Is it going to do that in a hurry? Because I can tell you right now, if it goes rapidly, it's the speed of advance and how high it's going and why it's going up. If it's going up from a strong economy, et cetera, those are good reasons. But if it's going up massively because of risks of default and, fear about the U.S. government or global risks and so on, anyway, that would be a different story. So you can see kind of how rates have gone up. Well, let's flip it around. Here is an ETF that tracks 7 to 10-year bonds. So IEF is one of the most popular. This is 7 to 10-year Treasury bonds. Now look at how it's opposite. It's basically the inverse chart. You'll notice, and I'll flick between the two, okay? Go back one, look at the, go back one, look at from about mid-August, it bottomed out, ran higher, a week or so ago it topped out, came in. Go to the next chart, mid-August, it topped out. It's the exact opposite chart. About a week ago it bottomed. They move it inverse, right? Bond prices have been dropping. Why? Because yields have been rising. In other words, new issuance. If I was to go out, if I were buying, in other words, a 10-year bond here, I bought it poorly. I locked in at a 2.8% yield. And now, just a month and a half later, they're yielding 3.2. So if I want to sell my bond, I have to sell it at a discount. My bond value has gone down. This is bond prices. It's gone down because new bonds are yielding 3.2, and I bought mine up here with a 2.8% yield. So you can see that inverse relationship, right? If we look at a few others here, let me move forward. TLT, this is one of the most popular. I actually had a trade on in TLT. Worked out. We had a put butterfly targeting this to go down here, and it worked out. Some of you might still be in that. It's expiration this week. We took profits, but if you still have the position on, still looking good. But it was a great trade, and TLT, it's a bond price, so we were betting on bond prices going down and yields going up. And so this is one of the more popular ETFs that people trade. And then BND, this is just corporate bonds. Vanguard example, these are corporations. So if you were to break this down, it would have Apple bonds and Google bonds and General Electric bonds or what have you, right? It's just a kind of a total bond market ETF. You can see again, bond prices have been dropping because yields have been going up. So let's go live here for a second and hold on. I'm going to pull it up and we'll take a look at a couple of things. Did I close that down? It'll take me just a second to pull that back up. But I'm going to show you a couple of things here. You can trade options on these ETFs. The problem you're going to get in, unfortunately, is that some of them are very illiquid. So there are good and there are bad ETFs for trading. And in the bond market, there's not a lot that have great liquidity. So if you get into the shorter term bonds, even the 10-year and so forth, the liquidity is not great. TLT is fine. It's the 20-plus year, but most of them are not. And I'll show you that here as we go. And I'll show you a couple other things. I mean, you could actually buy bonds directly from your trader workstation. You can buy treasuries and different things like that. Again, it's very slow. It's usually you would want to do that more from kind of a long-term investing approach, maybe retirement accounts and so forth, but you can do that. Good question. The comment came in, a question about laddering. Yeah, I could explain that. While Interactive Brokers is pulling up here, I didn't want it running in the background to slow things down. But a bond ladder, let me explain kind of the process behind it. So think about what a ladder looks like. Here, we'll draw it out. Okay, and this isn't a perfect example perhaps, but let's say you had a 2-year bond and well, let's just keep it in equal increments. 4 year, 6 year, 8 year, 10 year, so forth. Okay, it could have been 5, 10, 15, 20, 25, whatever. But a bond ladder, basically the idea is short-term bonds pay less interest than long-term bonds, right? So let's say that this was on, this could be a government bond or whatever. Let's just say it's U.S. government debt. Well, hypothetically, I'm gonna put higher interest rates than what you can actually get just to show the difference. Let's imagine this wasn't out of the question back in the day. In fact, we've got that popping up here. Minimize. Back in the day, U.S. government bonds did pay more in interest. So imagine a time when the 10-year was yielding, let's just say 10%, and the 8-year was yielding 8%, and the 6-year was yielding 6%. I just want to do this for illustration purposes. And the 2-year was yielding 2%. The idea behind a bond ladder is basically the idea that I want to lock in better interest rates, and these are headed, they're all moving towards essentially their maturity date. That's kind of like an options expiration. It's a maturity date where they'll pay you back the money. So let's say that we were going to invest $10,000 in each one of these. Well, here's the thing. As time ticks on, the short term will hit maturity, right? So as time moves on, this 2-year is going to hit maturity, and when it matures, they're going to pay us back the $10,000. Well, when that happens, this is now a 0, this is now a 2, this is now a 4, this is now a 6, and this is now an 8. I can take the 10,000, reinvest it in a 10-year bond that maybe is once again yielding me 10%. And look at what just happened. I just took the money that matured and it was paying a lower interest rate, and I put it back in the higher yielding. And then when this one comes to maturity, I'm getting rid of the lower yield and putting in the higher yield and reinvesting it. And you're laddering that so that over time, your short term expire. The long term becomes short term. Understand that. The long term bonds become short term bonds because time ticks away. So as you do this and you keep reinvesting it back into longer term bonds, you're locking in better interest rates because the long term bonds pay a higher yield. So the idea behind building a bond ladder is to have them staggered, but as the short term hit maturity, you then reinvest it back in the longer term maturity with a better interest rate. And then they move forward and you keep doing that. And over time, you keep acquiring a better yield in doing that. So that's a great question, and I hope that answers it. So let's jump over here. If this is more information than you ever wanted to know about fixed income and bonds, no worries, because for some this may be very insightful, and you might want to have some ladders and some things like that. And for others, they might be like, you know what, I'll invest in some of the ETFs in bonds and just stay invested and not do anything else with it. And some say, I'm not going to do anything with bonds. So there's all sorts. If we look here, I just built some. I wanted to show, here are some of the popular, like TLT. This is a bond ETF. You can buy it and you'll collect interest. It'll pay you yield. But this is an ETF company. Same with IEF and SHY. So you pay a little expense for them to keep your money invested in bonds. They'll do all the management. Is that a good thing? Well, they're just doing the work, and you're collecting whatever basically the rates are for these bonds. These are government bonds. So the expectation is that the U.S. government's not going to default. If they did default, then obviously these bond prices could collapse. These ETFs could collapse. I don't foresee that happening, but anyway. Here are some other examples. BND, we talked about corporate bond. AGG is basically the same thing. HYG is a junk bond. So if you were to invest in that, yeah, it'll pay you higher levels of interest, but understand that a lot of the companies within that HYG that they're investing in, a lot of the debt is risky debt. These are companies that could default. So there's more volatility in that asset. As we pull up the options of these, you'll notice TLT is very liquid. Okay, it's a good tradable instrument. If I go to November monthly, for example, look at some at the money options and so on, the bid-ask spreads are within a few pennies. That's what we look for, right? 75 by 78, 111 by 116, 104, 109, 65, 70. That's reasonable. If I were to change that and go to the short term, SHY, this is 1 to 3 year Treasury bonds. Should I trade any options on this? No, is my opinion. Again, I'll go to November monthly. Well, it's a disaster. 80 cents by $1.60, 180 by 260, 85 by 125, 180 by 260. It's just so illiquid. Plus, it just doesn't move. It's like watching paint dry. I mean, when you look at it, let me do one other thing. Just look at the difference. TLT is going to move around. It's a 20-year bond. It has more, movement. It goes from 120 to 115. It's still not massive, but there's some volatility in it. Look at SHY, which is 1 to 3 year treasuries. Well, even with all the volatility that we've seen in the bond market recently, it went from a high of 83.10 to a low of 82.85. Okay, there's just no movement. It's 1 to 3 year treasury bonds. There's nothing, could you invest in that? Could you buy this and just collect that interest that the 1 to 3 year treasury bonds are paying? I suppose you could, but you wouldn't want to trade options on it, right? If you look at some of those ETFs, here's the junk bond ETF, HYG, and it's reasonable. You could trade, whoops, I'm putting it in the wrong spot. If I wanted to trade options on HYG, it would be reasonable to do so. Again, I'll go to the November monthly, and 66 by 71, 138 by 160, 37 by 39, 65 by 67, and so on. Reasonable, right? Within pennies. So I could create an option trade. I could do something with this junk bond ETF and have a reasonable trade. And again, there's good volatility in it. From the high to the low, you can see the volatility in the bond market, 86.30 to 84.60. Now understand, again, they're not the most volatile assets. When you're trading fixed income, bond ETFs, and so on, there's not going to be massive moves, but you can see some volatility in that. You could buy bonds direct. So if we wanted to, buy bonds, here's an example. So if I type in US, and you'd have to have quotes for this. I'm not sure most of you have it or that you'd even want it on your account specifically, but you could do this on your own personal interactive brokers account. If I go to government fixed income, so I type in US, I go to bonds and notes, I can say I want US Treasuries, and then I can pick maturity dates. Let's say that we wanted to go out sometime, and so forth. You can actually select. Let me do it a different way. We could actually, so if I go US-T, we could actually select more things. We could go pick the maturity date, the issue date, the coupon we want, whether it's tradable or not. So let's say we wanted a higher yielding. Let's see if there's anything that's yielding 4.5%. Well, 4.5%, we have some choices here. These don't mature until 2036 or 2038 and so forth, but they're yielding 4.5%. Let's look at a quote on one of these. So here's a February 15th, 2036 U.S. government bond. If you were to buy this bond, it would pay you 4.5% annually. Notice that it's trading above its issue price, meaning when this was originally traded, so look at these other U.S. government bonds up here. This one's trading below 1, which means you're actually buying it, and you're going to make, so you're going to collect the interest, but you could make some difference between buying it at 98 and it paying you 1 at maturity. You're buying at a discount. Here you're buying at a premium. So I'm buying at 116 something that's going to pay me 100 at maturity. Now maturity doesn't come around until 2036, but I'm paying more than what its face value is. Why? Why do I have to pay more than its face value? Because it's paying me 4.5%, which is a better yield than what new issuance are coming out at, right? So it's a trade-off. I'm going to collect more interest, but if I want to buy it from this person that owns it right now, I have to pay them a premium for it. So I'm going to lose a little bit in that over, when it matures in 2036, but I'll get paid more interest over the duration. Again, you can buy these direct. You could buy these and sell these and so on. There's not a ton of volatility as a general rule. Yes, you could buy corporate bonds. Let's say we wanted to look at General Electric. If I type in GE, I go to General Electric, fixed income right down here, corporate fixed income. I click on their bonds. GE has a lot of different businesses. Remember, they bought out Baker Hughes, which is an oil service company. They have GE Capital. That you can buy GE Company. We can choose maturity date and coupons and so on. So let's say we wanted this to mature soon, and maybe GE is going to go bankrupt. But let's say we trusted it into hypothetically 2019. Okay. And we were willing to collect 2.979. Okay, I'm going to add that in here. So this matures on January 14th, 2019. You can see it's basically trading for face value for the 100, right? So, 1,000 invested should pay you back 1,000, and it's right around those levels, and it's going to pay you about 2.97%. until January 14th. Well, could something bad happen? Could GE default on that over the next few months? It's possible. Probably not going to. They'll cut their dividend. They would do other things. I think you'd be safe to January 14th, 2019. Are you safe to 2025? Well, I'm not going to make that assessment. And you might not even be, I can't make any guarantees of anything with GE. But anyway, make a long story short, you can pull up corporate bonds, you can pull up treasury bonds, you can trade these ETFs and things through the options market if they have the liquidity for it. Good question. Could we pick up these at a discount? Well, so the bond ETFs are kind of tricky. That you could essentially put on strategies to acquire them when the prices come down, but remember that they're constantly managing that ETF. So they're kind of creating ladders and whatnot inside of this for you, because as money matures, they reinvest it, and they do that automatically as the ETF company. So within TLT, do they own 20 plus year treasury bonds? Yes, they own the actual government bonds, and when they mature, they reinvest that money back in. So you're making an assessment. When you buy this, you're just buying a big basket of 20 plus year treasury bonds that in some cases have gone to shorter durations and so forth. So it's just, you can't really buy the pieces of it. You're just buying the whole thing. Yes, if you buy bonds, you're saying, A, I'm comfortable with the amount that it's paying me in interest for buying this bond. And B, maybe I think that yields are going down, so this bond price will go up, and I can sell it at a premium. Those could be two different reasons to buy a bond. That's exactly right. All right. Well, I hope this was helpful. Thanks, everyone, for being here. We'll see you next time. Goodbye.